So last time we talked about what the stock market is, but how do you actually start buying and selling stocks? There are actually different types of orders that change how much you pay, how much risk you take, and if the order even goes through at all. That's what we'll learn about today. Today, we're breaking down stock orders in the simplest way possible. This is lesson 2, understanding stock orders. Okay, so order type number 1 is a market order, which is the fastest way to buy and sell stocks. You're basically saying, I'll take the best price available right now. Order type number 2 is a limit order. This allows you to set a specific price that you want the stock to be sold or bought at. If you place a limit order for a stock to be bought at $9, it can go one of two ways. So either the stock hits the $9 and it will buy however many shares you chose to buy, or it might never hit the $9, and if that's the case, then the order will not go through. You can also set specific time frame, so you can have it so that it's till the end of day, so until the end of that trading day, or you can have it so that it's set for a week, a couple weeks, a few months, or indefinitely until the stock hits that specific price. Limit orders are great for making sure that you are not overpaying for stocks, but it also does mean that if your price is never hit, then the order won't go through. Okay, so assuming that this is your stock, it can go one of two ways. So assuming that you are currently sitting at the $10, if the stock goes up and you have set a limit order for $9, then if it goes up, then no order will go through. But if the stock goes down to the $9, as soon as it hits the $9, your order will be confirmed, it'll go through, and it'll go directly into your account for that $9 price, or whatever price you decided to select. Number 3 is a stop loss order. Stop loss orders are all about protection. That way, if a stock falls to the set price, it will automatically sell and limit how much you end up losing. All right, let's say that you bought a stock for $50 and you set a stop loss at $45. So if the stock were to drop down to that 45 mark, then automatically it will sell off those shares, and that way it is kind of like a safety net to stop big losses before they get any worse. Assuming that this keeps dropping, it will stop it right here and prevent you from losing any more money. All right, lastly, we'll talk about ask price versus bid price. The bid price is what buyers are willing to pay. The ask price is what sellers want to get. For example, imagine you want to buy trading cards and you will say, I'll pay $5 for it. That's the bid. The person selling the card says, I'll sell it, but only for $7. That is the ask price. And the spread is the gap between those two numbers. So because the bid is 5 and the ask is 7, your spread would be $2. So the spread shows you the difference between what buyers are willing to pay versus what sellers are willing to sell for. A small spread signifies that the buyers and the sellers more or less agree with what the price of the stock is. The bigger spread means that it will be harder to trade quickly because the buyers and sellers don't quite agree on the price. Okay, now that you understand the basics, let me show you what it actually looks like when you are placing an order. Don't worry, we're not risking any real money here. We'll be using Investopedia's simulator. It's free to use and you guys can follow along. That way you guys can get some practice as well. All right, so jumping onto the Investopedia website, as you can see here, this is what it'll look like when you first go into it. If you guys want to follow along and try out the simulation for yourself, we can go to trade. This will prompt you to either log in or register, which you can absolutely do that. It doesn't take too long. Once you open it up, you will be brought here to the account section where your portfolio is. You will have your overview as well as your performance. So in your overview, you can see that Investopedia instantly gifts you $100,000 to invest. This is not real money, so this is more just a simulation, but it tracks the stock market, and you can very much so get a hands-on experience as to what it can look like, what it can feel like. So once we go here, what we want to do is go to trade. We want to look up our company. So assuming that we are looking for Apple, we will type in the symbol or the ticker number or ticker symbol, sorry. Can hit Apple. It will pull up the Apple charts. You can check the 1 day chart, 1 month, 3 months, 1 year, 5 years, and all times. Chart, we'll look a little bit deeper into this in later videos, but for right now, what is important to us is the actions down here. So action is a buy or sell. Those are the ones that we care about right now. Right now we have it set to a market order, and the duration is usually day only. Typically with a market order, it will push the order right away. As we learned, it was the fastest way to get your order through. So you can select your quantity. So if you want to buy 5 shares, 10 shares, 100 shares, completely up to you. So as soon as you have the action on buy, you select the quantity, it's on market, and then you say preview order. It'll show you what the order is, if it's a market or limit order, and how much you're going to buy and how much that'll cost you. Next up, we will have our limit order, and the only extra thing that we get here is the price. So right now the stock is trading for $232.14. So if we think that the stock is going to go down, so we can get a slightly better price on it, we can select the price to $230. That way we can get it for $2 cheaper. And we can select the quantity, the action, so buy, limit is the order type, and then we can either set it to day only. So at the end of day, if this order doesn't go through, it will be canceled and it will be there no more, or we can set it to good until canceled. So what this will do is this will leave this active until the trade either goes through or until you decide to manually go in and cancel the order. Perfect. And then the last one is our stop limit, and this is our stop loss. Same thing, but it's just called the stop limit on this website. So same idea. It will be in the cell. Stop limit. Then you can select the quantity of how many shares you want to sell, the price that you want to stop loss at. So assuming that I bought it for, once again, the $232, I can set a stop loss for $225. That way, if it drops to, if it keeps dropping from the 232 to 225 and maybe even more, as soon as it hits 222 or 225, sorry, it will automatically sell the shares for you, however many shares you selected. And same like the limit order, you can select it so that it's good just for that day or good until canceled. Lastly, we will take a look at the bid and ask price. So it'll be right here. So as you can see, the bid price is $232.21 and the ask price is $232.27. So the spread between those two is only 6 cents, meaning that for the most part, buyers and sellers agree with what the price is, meaning that it will sell rather quickly. You can either buy or sell rather quickly, and you can get a fairly good deal. All right, so we will do a quick show as to how you would buy it. So we're just gonna buy some shares. Let's say I want to buy 10 shares of Apple as a market order, and we will have it till day only. We can go to preview order. It will show us what we're buying, how much, what the duration will be, the estimated price of the stock, the quantity. Commissions is if there are some brokerages that will charge you either a $10, $20 commission fee. So anytime that you buy or anytime that you sell, you will get charged a commission. Since this is a free website, we will not be charged any commission. And then our estimated price, so it will be basically our stock price times our quantity, and that is how we get our estimated total. So then we can submit our order, and then boom, boom, it'll say trade confirmed, and it will send it through. But right now, because it is very late, the market is not open. So if you can see up here, it'll show you market is closed and will open in 2 days, 5 hours and 3 minutes. So once the market actually does open, the order will go through and it will buy it at whatever price the market opens up at. So that's how you would go about that. You can also, once again, do the same thing and do a limit order, which same idea. You can just put I want to buy it for 230. Still my same 10 shares, and I can have it good till canceled. Preview order. It'll basically give you the same rundown. It'll tell you the duration here, and the only difference will be the price. Since we want to buy it for 230 and the 10 shares, it'll just give us that. We can submit our order, and then if and when it actually hits the 230, our order will go through. So we will leave that one, and we'll just let the other one do its thing. And next time once we come back, we will actually be able to see it here in our performance and see how it's doing. The other thing that we can do is, just in case, to cover our butts, if we set it to sell, stop limit, we will set our 10 shares, and assuming that, or once the market opens, it will buy it for whatever price it opens at. So assuming that we don't want to lose too much money, we can set this so that if it drops to 125, it will automatically sell all of our shares since we only had 10, and we can have it until canceled. We can put that order through. Right now it's not actually letting me because I don't own any amount of the stock, but if you did own some, or if we were to come back the next time that the market opens and put the order through, then it will let us do it, since at that point we would already own the 10 shares, but since right now we don't own any, it is not allowing us. But that is more or less how that would go. Okay, quick check for you guys. Leave your comments down below if you know the answers to these questions. So the first one is, which type of orders protect you from big losses? Question number 2 is, how do you figure out the spread of a stock? So to recap, market orders are about speed, limit orders are about control, stop loss orders are about protection, and bid versus ask price show you the gap between buyers and sellers. All right, next time we will be looking at how to build a portfolio. If this video helped, make sure you like, you subscribe, and that way you don't miss lesson 3. See you guys next time.